Hello friends, welcome to this short session about various RBI initiatives to bring back economic stability in our economy in the context of the COVID pandemic. Okay, and we will see what are the remarkable features of this RBI intervention. And before going to the details of our session, we should have a quick review about various initiatives and effort made both by the government as well as the RBI. Okay, and this table shows a quick timeline, okay, of the government interventions, right, to fight the COVID. And we are starting with the April 9 initiative. Okay, again the government has launched on April 26 the Pradhan Mantri Garib Kalyan Yojana. Similarly, the all important measure initiated by the government, Atmanirbhar Bharat Yojana, it was launched by our Prime Minister on May 12, and followed by that, Finance Minister has unveiled several measures on different sectors under this Atmanirbhar Bharat. Okay, and coming back to the next side, that is from the RBI side, there were a lot of initiatives starting from March 27. The RBI came out with a usual repo rate cut, and similarly cut in reverse repo. And the popular measure, perhaps you might have known that the 3-month moratorium on all EMIs. Okay, similarly it was continued on April 1st, on April 17th, April 20th. Okay, and on April 27th the RBI has declared a special liquidity facility for mutual funds. Okay, on 22nd of May again it declared a cut in repo, reverse repo, MSF, etc. Besides extending the moratorium to 3 more months. Okay, and we are not going to the details of all these measures. Perhaps you might have gone through this already as part of your current affairs update. The most important problem the RBI has covered during this period was it has enhanced liquidity in the economy, because the liquidity in our economy depends upon the activities of the commercial banks. Okay, because India is a bank dominated financial system, the liquidity in the economy should be delivered by the commercial banks. We will go to see how the commercial banks managed their business and activities during this COVID period. Okay, so during this COVID period there came a particular behavioral pattern for the commercial bank, because they sense a danger. They came to that the business are coming down, okay, and loans are going to be risky, and besides that NBA problems are going to be aggravated. You can easily understand that, because already the commercial banks are on the having a backlog of NBAs. Okay, and given this situation, if they are giving further loans, it will be a dangerous situation for them. So they started to slow down loan delivery. Okay, and they became in that process risk advertised. Okay, and credit supply to the real economy came down as a result of the declined level of loans delivery by commercial banks. The end product of this particular behavior pattern by the commercial bank is that they record some sort of a liquidity squeeze, and several of the financial entities and our enterprises, they faced shortages of money. Okay, and we will see one by one what are the main problems confronted by our entities and financial institutions. For example, we are coming to the first category, the non-banking financial companies. So they are not getting money, because the NBFCs are very important in India's financial system, because they are providing funds to rural areas, the small entities like that, and similarly the same is the case with the microfinance institutions. They also faced a cash crunch, and there was no different scenario for the MSMEs as well. They never got supporting finance in the context of the COVID crisis. The financial market was in a real strain, and the situation was not much different for financial institutions like NABARD, the big financial entities which are usually giving loans to other sectors, and Exim Bank, SIDBI, etc. They were facing trouble in mobilizing funds. These institutions, they may be issuing bonds in the financial market and getting their funds so that they can give loans to different enterprises and other financial institutions. And as a result of the risk aversion attitude of the commercial banks, there occurred a curious development. Okay, what the commercial banks are doing with their own money, they were storing their cash with the RBI. Okay, so this is the real problem that we are discussing. They are storing a sizable part of their lendable resources or lendable money with the RBI. You know that there is a mechanism called reverse repo. We are not going into details of reverse repo or how it works. Rather, you should understand that there is a mechanism under RBI which is a part of the liquidity adjustment facility of the RBI. Okay, and now we are going to have a table here, and this table shows the turnover in the repo and reverse repo facility of the RBI, and I hope that you have some sort of an basic idea about the functioning of repo and reverse repo. So repo is basically a facility where the RBI will be giving money to commercial banks. Okay, one day loans to commercial banks. When the RBI is giving such one day loans to commercial banks, the RBI will charge a rate of interest called repo rate. Okay, so such idea, such things, I think you already knows, since you are not just a beginner. And this is about repo. Okay, and repo is liquidity injection. What is that? It is liquidity injection. That means RBI is injecting liquidity into the financial system. Okay, into the financial system through commercial banks, because basically the commercial banks are the borrowers under repo. And coming to the next one, that is reverse repo. What is happening there? In the case of reverse repo, the commercial banks, they are giving funds to the RBI. Okay, in this scenario, the commercial banks who have excess funds, they are giving money to the RBI. In return, they get a rate of interest called reverse repo rate. Okay, so when you are going through this table, a table which illustrates the liquidity adjustment facility of the RBI, which includes both the repo and reverse repo. Okay, repo and reverse repo. This table shows the level of turnover of that liquidity adjustment facility. Look at this table that illustrates the liquidity operations of the RBI. Okay, from May 1st to May 22. What is the level of repo? 0. All across these 22 days, no commercial bank has borrowed money from the RBI. Commercial bank doesn't need any money. Okay, so repo turnover became 0. Coming back to the other side, what about the reverse repo side? Okay, the reverse repo transaction, that means the commercial banks, they stored, okay, they are given loans to central bank, that is RBI, around 27,000 crores rupees on May 1st. Okay, and go up to that table. Okay, and you can see that on May 22nd, okay, 7,30,473 crores were stored by the commercial banks together with the RBI. Okay, so 7,30,000 on previous date, 7,70,000, 7,46,000. You can see that the LIF was dominated by what we can say the reverse repo operations. The repo operation recorded 0. So this picture shows an idea. Okay, there is excess liquidity in the system. Commercial banks were transferring funds to the RBI. Okay, and again we are coming to one more table, no, rather a diagram. This diagram also illustrates the same story. Okay, but the difference is that it shows the figures for 1 month. Okay, between April 21 and May 22. Right, so you can see that from April 20 to May 22, throughout this period, this 1 month period, there were only reverse repo. Okay, there were no repos. All this bar shows the amount of money that the commercial banks parked with the RBI. Okay, there were tremendous level of liquidity absorption. We can say reverse repo is liquidity absorption. Okay, now again we are having a diagram. Okay, in this diagram we have both reverse repo and repo, and again this data is between January 1st 2020 and May 22 2020. That means from the beginning of this calendar year, what is the level of repo? This diagram is dominated by only one color, that is blue, or what we can say reverse repo. Okay, can you see any patches of repo or yellow? In the beginning time, you can see that there's a patch of what the yellow color, that indicates what the repo operations only from January to till around what we can say around February 15 there were repos. Okay, after that there were no repos, only what reverse repos. Okay, so this means that the banking system was full of liquidity, and banks doesn't need any money from the RBI. There is no need for repo. There is only need for what we can say reverse repo. The commercial banks were parking their excess funds with the RBI. So this diagram is dominated by reverse repo. Throughout this calendar year, there were reverse repos and only slight volume of repo. That shows the liquidity position of the commercial banking system. Here, this diagram is also another version of the previous data. Okay, from January 22. Okay, January 1st 2022, May 22, 2020. Okay, this rectangle diagram, it shows a colorful demonstration of both reverse repo and repo. You can see that the repo volume is quite less. Okay, it was there in the beginning period of this calendar year, around what we can say till February 11th. Okay, so there were repos. After that, there is only what we can say reverse repos. Okay, this shows that there is excess liquidity in the banking system. Okay, banks sensed that there is a danger. They were not ready to give funds to the real economy, rather than they are giving or parking their excess money with the RBI itself. Okay, and then what are the possible outcome of this trend in the financial market? So we saw that the banks were not ready to give loans to the real economy, rather they are storing their money with the RBI. So what is the outcome? There will not be much lendable resource in the market. Okay, institutions and entities like NABARD or other corporate entities, NABARD is commercial or development financial entity. Okay, other institutions, entities like corporates, going into the market to sell their bonds so that they can get money, and other instruments, how to do with higher interest rate, because whenever they are going to the financial market to mobilize money, there will be higher interest rate, right? And several of them, including NBFCs and MFIs, they may fail to get money. RBI sensed this danger. There is low liquidity in the financial system. Okay, remember that in the economy, in the banking system, there is the total deposit is around 130 lakh crores rupees. You may have this idea because when the RBI reduces CRR by 1% or 100 basis point, money supply will be increased by 1.3 lakh crores. Totally, we assume that the total deposit in the banking system is around 130 lakh crores rupees. Assume that 7 lakh crores rupees out of that will be stored every day with the RBI by the banking system. So that shows the way of liquidity operations. Okay, the behavior of the commercial bank system. If that trend is there, how the financial institution and other entities can get money. And here we are seeing what the RBI has done to reverse this trend. So in the previous session, we just discussed on gone through the various initiatives made by the RBI to overcome this liquidity stress, and what were RBI's response. Two types of interventions were made by the RBI. So to end this liquidity problem, the first one is RBI encouraged banks to lend rather than keeping money with the central bank. Okay, the first purpose for the RBI is to ensure that banks will be lending their money rather than keeping their excess money with the RBI. Okay, for that, what the RBI has done, RBI steeply reduced the reverse repo rate compared to repo rate. Remember, compared to repo rate, the reverse repo rate has been reduced more than proportionately. Both repo and reverse repo rate has been reduced, but reverse repo rate has been reduced more than proportionally. This is the one way in which the RBI has countered this adverse trend. Okay, and secondly, the RBI brought some unique facilities. You may have heard about these facilities, but you may not have that much idea about what is the relevance of these facilities to give funds to all sections of the economy, all sectors of the economy, different types of enterprises, financial institutions. What were these facilities? You might have heard. Okay, targeted long-term repo operations. Okay, TLTRO 1 and TLTRO rather, I would like to write it again, because this topic is TLTRO 2 version. So these were the two TLTRO versions. You might have gone through that. We are not discussing them in detail, but understand that special liquidity facility, special refinance facilities. Okay, we are now concentrating on the first one. Okay, a cut in reverse repo rate to discourage banks to keep money with the RBI. The prevailing trend is that banks are keeping their funds, excess money, with the RBI. To counter this, to reverse trend, RBI has reduced the reverse repo rate steeply so that banks should be encouraged to give loans to the real sector. Okay, now we have just brought back that table we saw in the initial part of our class. This was the response timeline of the RBI during this COVID pandemic time, to stabilize the economy. And here we are identifying both the repo and reverse repo. The repo cut are shown in blue color. Okay, 2 times RBI has reduced repo. Okay, and the reverse repo cut are indicated in red color. 3 times RBI has reduced the reverse repo. So remember, more than the repo, the reverse repo has been reduced. So this is just the idea I would like to give you from this table. All other concepts and other events, you might have gone through already. We are not discussing all such details, and here again we are going to see a diagram. Every diagram shows some message to you. So what about this table, rather this diagram? And here this diagram shows the corridor in monetary policy. Okay, what is that? The corridor in monetary policy. Corridor in monetary policy. Okay, you might have heard that corridor is one of the monetary policy tool of the RBI. What is the corridor? Corridor shows the area between the marginal standing facility, the emergency lending facility of the RBI, and the reverse repo facility. So midway between these two, what goes? The repo goes. So this is the MSF rate by the beginning of this year, by the beginning of this calendar year. What was the MSF? It was around 6.75%. Okay, and the repo rate was 6.5%. Okay, and we can see that the reverse repo rate was 6.25%. So there was a gap of how much? 50 basis points. Okay, so repo rate was 25 basis point higher than the reverse repo rate, and it is 25 basis point lower than what we can say the marginal standing facility rate. Okay, when we are coming to the recent period, you just look at this gap. The repo rate was 4.4%, and similarly the MSF rate was reduced to 4.65%. So the gap is how much? 25 basis points. Okay, and when we are coming to looking at the reverse repo rate, what is the reverse repo rate? It is 3.75%. What is the difference? It is how much? 65 basis points. Okay, how much it is? 65 basis points. So the gap between the repo rate and the reverse repo rate has been widened, or what we can say better, we can conclude that from that diagram you can see that the reverse repo rate has been brought down more than proportionately, okay, compared to repo rate. So there is huge difference between what we can say the repo rate and the reverse repo rate, and this situation we call as asymmetrical corridor. Asymmetrical corridor. Okay, so this asymmetrical corridor has been created by the RBI to discourage banks to park their excess liquidity with the RBI. Okay, to discourage banks, because the banks are getting only low level of rate of interest when they are keeping their excess money with the RBI, only 3.75%. This asymmetrical corridor has been created to discourage banks to park their excess money with the RBI. Okay, again we are reproducing the same diagram by extending the RBI's action on May 22. Okay, May 22nd, 2020. So the date is not there, but remember RBI has reduced the repo rate, reverse repo rate, and marginal standing facility rate. So this trend shows the intervention by the RBI during the COVID time. Okay, RBI has reduced repo rate to encourage investment, consumption, etc. Okay, RBI has reduced reverse repo rate more than proportionate. Now it is 3.35%, not 3.75%. Okay, we are having the updated data here, and the difference between the reverse repo rate and repo rate is higher than the difference between the repo rate and marginal standing facility rate. The second way through which the RBI ensured liquidity in the economy is this. Here the RBI brought some unique facilities to give funds to various sectors of the economy. We will see which are those unique facilities. Okay, to which sectors those unique facilities are provided by RBI. The first one is TLTRO. Okay, targeted long-term repo operations. From the exam point of view, you might have some idea about long-term repo operations. Those repo operations are loans given by RBI, okay, to commercial banks for a considerable period like 1 year, okay, 3 year, like that. So we are not going to in detail about TLTRO or long-term repo operations. When long-term repo operations, that means repo is usually for a small period, but long-term repo is for what we can say much larger period like 1 year and 3 year. Here the commercial banks will get money. Okay, they will get money from whom? From the RBI to give loans to certain sectors. Okay, certain sectors. That is why it is called targeted. Okay, sectors like like corporate bond market. Here in the case of TLTRO, the funds were given to commercial banks by the RBI, so that the commercial banks should invest in corporate bond market. Then coming to the next one, TLTRO 2 version. Here, the banks were given money by the RBI. Okay, RBI, so that the banks will be investing in instruments or debt instruments issued by NBFCs and MFIs. And the third special facility or unique facility by the RBI to enhance liquidity was special liquidity facility, and this is for mutual funds, and the amount was 50,000 crores directly to the mutual funds, because the mutual funds industry is facing severe strains in the absence of liquidity. And the last one is special refinance facilities for a total amount of rupees 50,000, which were given to institutions. Remember, NABARD, SIDBI and National Housing Bank. These institutions usually gives loans to other institutions regarding in the housing sector, in small scale industry and for agriculture. So these institutions also like money. They conventionally mobilize funds from the open market, but the open market, bonds might have been quite high, bond yields are high. Similarly, there is lack of liquidity because banks are not giving that much money to the open economy. So in this context, the absence of liquidity, the RBI directly has given liquidity through different facilities, including TLTRO, TLTRO 2. Special liquidity facility and special refinance facility. So these are the two types of initiatives launched by the RBI, to face this liquidity stringency situation in the economy. And these features and these interventions makes RBI's policy unique to fight the COVID created economic instability, right? Okay, that's all about this class. Thanks for listening.